right, well, thank you, Amy, and thank you to everyone for joining us here today for a Provider Relief Fund update on period 4. Reporting period, or the reporting window, has now started and ends on March 31st, 2023. So glad to have everyone here today to discuss not only some of the new nuances with the period 4 reporting, but also just to give some good reminders, tips, lessons learned, and that type of thing. So I'll go ahead and introduce myself for those of you that I have not, I guess, virtually met on webinars before. My name is Ashley Brandt-Judah, partner with Eide Bailey. Work primarily on the audit and assurance side, but have spent the last couple of years focusing on the provider relief funds as well. The reporting, the lovely audits that have had to come through recently. So spent a good portion of my time with that. And I see Tyler nodding as well, and I'll go ahead and let him introduce himself.
Yes, thanks, Ashley. Welcome, everyone. I am Tyler Bernier, partner out of our Oklahoma City office. And just like Ashley, audit primarily, exclusively with healthcare organizations. But for the last few years, since that fateful day in April of 2020, when those payments magically arrived, been focusing on provider relief funds, talking through, I know a number of you probably have seen some of our past webinars, and the single audits, right? All of the testing on the back end and the fun that we get to go through. And you know, Ashley, I know you were looking at this too. It's almost been a year since we last did this. So a lot of stuff to catch up on. I think that was about 3 haircuts ago for me. And I find that funny because I look at my picture and I'm like, wow, that was like 6 haircuts ago.
Yeah, that is right. There were a lot of changes, those that have followed Tyler along the way. But yes, I think we determined our last provider relief webinar was February 1st of 2022. And would love to say I have not talked to Tyler about provider relief funds since then, but that is unfortunately not the case. We've been certainly buried in all these things. But yes, glad to be back and to go through some items with everyone today.
And why would you be glad to not talk to me?
Well, I mean, it's not that I don't want to
go.
talk to you, but I'd love to talk to you about something else, but maybe someday. We're not there yet.
Fair.
All right, so just to give everyone an overview on the agenda today, what we're going to start out with is just a really high-level provider relief fund overview. Not going to go into a lot of details on it, but just, again, high-level overview on the provider relief funds and really what we're covering today. Then we're going to spend a considerable amount of time going through some various historical findings and errors that we've noted, and a lot of this specifically through that audit process of single audits that we've completed. And so I think good things to know just as you're continuing to move forward with your reporting, and hopefully things that you can consider here for reporting period 4 and beyond.
So Ashley, have you ever been like sitting through a presentation and the presenter calls someone out for doing something wrong and you're like, I know they're talking about me? Yeah. I mean, unfortunately, I think there's probably a number of people on that are thinking that exact same thing when they just saw historical findings and errors. So at least I can tell you this, there are a lot of you. There were numerous things that we identified because of the issues. And we probably may be talking about you, but we're probably also talking about others. So it's you're not alone. That's probably the big takeaway.
I think that is the key point of this, is that if we're talking about it, you are certainly not the only one. That means we've seen it more than once. So there you go. Yes. a lot of confusion and different things out there. So certainly makes sense that we all know the guidance has not been very clear. But yes, after we talk about that, we'll go into some current period reporting reminders and specifically talk about some nuances that are a bit different here in reporting period 4. And then we'll just end with some overall tips, recommendations, and things to consider as you're moving forward with your reporting.
And before you kick it off, one thing I always like to point out, there are going to be a wide range of people that are on this webinar, from individuals that received, relatively minor, and I say relatively, 10, 20, 30, $40,000. And there's going to be groups that received millions, if not tens of millions of dollars. All of them dealing with different and unique issues. So as we talk through, we kind of have to talk somewhat generically because it is so broad, but we're going to try to hit points that cover that entire group. So hopefully that makes sense. If we're talking about things and you're thinking that doesn't relate to me or this doesn't, sometimes it may not, sometimes it may, but it is a wide range of individuals and groups that are impacted by this.
Yes, absolutely. That's a great point, Tyler. And I think along those lines, a lot of the things we'll be talking about today might be items that we've identified as part of that single audit process. But really, even if you were not required or will not be required to have a single audit in the future, I think it's still, a lot of them are good tips that are still just relevant to the reporting and relevant to others, even if you're not required to have that specific audit done. So overall now, like I said, we just want to do a very high level overview of the Provider Relief Fund in general and really what we're talking about here. So, during the COVID timeframe, there were, of course, a lot of different funds that were being thrown around, showing up in your bank accounts. So really, which funds are we talking about today when we're talking about this reporting? And so you can see here, the green check marks, those are the ones that we're talking about. So basically, any of the Provider Relief Fund general distributions are included in this reporting. And so specifically for this period of reporting, it's going to be primarily those ones that were received, or not primarily, it will be those ones that were received July 1st of 2021 through December 31st of 2021. But overall, it's the general and then any of the targeted distributions, with the exception of any payments you received for uninsured patients, underinsured, or if you have a rural health clinic and receive those COVID-19 testing or those testing and mitigation funds. But really everything else, so including the nursing home infection control, the quality incentive, and then those ARP rural distributions, those are all going to be included in the discussion here today. So just a high level overview again of terms and conditions. And so if you have been on our webinars in the past, I can guarantee you've probably heard us talk about this more times than you've ever wanted to. But I think always important, we always like to start out with just those general terms and conditions. And so when we're talking terms and conditions here, we're talking about the general, targeted, and those American Rescue Plan or those ARP rural distributions, with the exception of the nursing home infection control, which includes the quality incentive, and then some of those other items not included in the reporting. And the reason why I bring that up is that even though the nursing home infection control are included, they have different terms. So not going to be covering those today. But for the others are really just those general provider relief funds. Within the terms and conditions there, notes that the recipient certifies that the payment will only be used to prevent, prepare for, and respond to coronavirus. So that's another term you're going to hear a lot, that prevent, prepare, respond to coronavirus. And that also it will reimburse the recipient only for healthcare related expenses or lost revenues that are attributable to coronavirus. And so we'll talk just a little bit about what that means, those healthcare related expenses and also those lost revenues. And then the other big piece is that you can use the payment to reimburse expenses or losses, but not ones that have been reimbursed by other sources or that other sources are obligated to reimburse. And that's a section when Tyler gets into talking about some of the findings, we'll definitely address that reimbursed by other sources and some of the items that we're seeing there. So when we're talking expenses, so what does it mean? Expenses attributable to coronavirus. And this is something, unfortunately, the answer to that is quite vague. And I know has been the topic of many, many discussions over the last couple of years of what is an allowable expense? Can someone please tell us that? And really the latest guidance, and this is pretty much what we've heard all along, is that the guidance is quite vague. And really what they note is that the expense must be used to prevent, prepare, and respond to coronavirus. And really, it is up to the provider to document really how they consider that expense to be to prevent, prepare for, and respond to coronavirus. And so again, there's a lot of judgment involved in that. We hear a lot of different things, but that's where one of the things you'll hear us continue to stress throughout the presentation today is documentation, 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 because that's really what it's going to come down to. Is it is really going to be your responsibility as the provider to be able to come back to HRSA and explain how was this expense to prevent, prepare for, and respond to coronavirus. And then on the lost revenue side, kind of an unusual concept prior to COVID and the COVID funding. But essentially they said you can be reimbursed for lost revenues, and they give you 3 different options for how you can go about that. And so the first option for calculating lost revenue is what we call option 1, which is essentially the comparison of every quarter in the allowable period back to the same quarter in 2019. So as we note here, using 19 as the baseline. So example, comparing Q1 of 2020 back to Q1 of 2019, Q1 of 2021 back to Q1 of 2019. So this is a pretty common approach that we see, is just using that comparison to the actual revenue. And again, we'll go into some detail later on some things that we've identified, issues we've seen when using this specific methodology. Second option they give you is the comparison to budgeted revenue. So essentially just comparing what did our budget say we were going to have for revenue, what did we actually have for revenue. The interesting piece with the option 2 comparison to budget is that it specifically notes in the guidance that the budget must be approved for the entire period of availability prior to March 27th of 2020. And so that obviously creates some issues, as you'll see on the next slide. And as we move throughout and talk about the periods that are being reported on, most organizations don't have an approved budget that goes out several years. So we'll talk about, okay, what are some ways, if you are running into that issue, some ways that you can work around that. And then option 3, which again, we'll continue to talk about and we'll cover in more detail later, is this alternate reasonable methodology, which is basically where if option 1 or option 2 don't make sense for your organization, what is another way of looking at it? What is our other reasonable method for determining lost revenue? And so along with that, you'll have to submit a narrative document and a calculation of the lost revenue. Again, we'll cover in more detail later the specifics of what that needs to include.
So Ashley, for option 3, didn't the guidance say something about like, if you use that option, you're at higher risk of audit? And so doesn't it seem like that's a scary one?
It does. And yeah, like I said, that's one of those, as we're talking through the considerations, that's where we'll really talk about that documentation piece. And yes, totally agree. So it does specifically say in the HRSA guidance that there is an increased likelihood of audit. But what we've tended to see as we move forward is that for so many organizations, it is really the method that makes the most sense for various reasons. So again, I think it really just comes down to making sure that your methodology is well documented. The other piece of this is that if HRSA does deny your methodology, you do have 30 days to then either complete your report using option 1 or option 2. So if you're in a situation where you're not really showing lost revenue under option 1 or option 2, doesn't really hurt to try option 3, and essentially you'll still get the option to, I'm saying option a lot, but yes, you'll still get the option to go back to one of the other options. So yes. Well, like I said, we'll talk, because I think it's definitely the documentation is going to be a really important part of this. So we'll talk a bit more about that as we move forward. And then the other, I would say, if there's going to be a slide that you keep in this presentation and put somewhere, it is going to be this one, the infamous when to report table. And so right now we are currently in period 4, as I said. So this is if you received more than $10,000 between July 1 of 2021 through June 30th of 2021, the reporting time period is now. And so just very important. But essentially, keep track of this. It's all based on when you received the funds, which is really the important part. So just really encourage everyone to take a look and make sure that they are tracking when they receive those funds and that they are reporting when they need to, because there is certainly not a mechanism for extensions or anything of that nature. So definitely want to make sure that you're reporting when you need to. Okay, now I'll turn it over to Tyler to walk through some of our historically noted findings and errors.
Thank you, Ashley. So as I kind of alluded to, many of these are because of what we saw and encountered through single audits. And as we put this together, I think Ashley and I kind of got to the point of this is really the key piece we're going to focus on, because we can walk through the individual steps to get things done, and we've done that before. Really, though, what I think that you need to know and understand for this reporting is how not to get it wrong, right? That's kind of the key. So how do we secure our funds? How do we get this as accurate as possible? And maybe what things do we need to be aware of to avoid going forward? So we will protect the guilty and innocent. I'm not going to call out any specific individuals or groups, but as I mentioned previously, know that you're not alone. In almost every one of these scenarios, there are multiple examples that we have. Also know, as auditors, we do not find joy in finding things that are wrong. In fact, it just creates more work. So it
does. That's what I was just going to say, that it really does. It's more work for us too, not just you. So we really don't like it. We don't.
No. So it's in everybody's best interest to limit not only the number of errors, findings, et cetera, but definitely limit the risk of potentially having to pay back dollars, especially as the healthcare industry just keeps tightening, right? Definitely not in a great spot with no additional funding coming out. So some of the overall reporting issues, these are things you probably would be aware of. Inaccurate calculations, just errors in formulas. As we're going through numbers, almost everything seems to be in Excel, right? So as you're working through Excel schedules, make sure that the formulas are correct. The calculations that are being performed, they are what we think that they are. And as we go kind of on the tips, an obvious tip's going to be, make sure someone also looks at those. Don't just do a high level review, click on some cells and make sure they're adding up what you think they will, that they're pulling information from where you think they are. Errors in data entry. Once again, pretty simple area, but it is transposing numbers, adding an extra 0, not having the decimal point in the right place. All of those have shown to create errors and issues, and sometimes relatively substantial ones. I have more than one example of 6-figure errors that are purely due to keying in the wrong number. So making sure that when you're doing that report, you are comparing it back to the original supporting documentation. Using the right supporting documentation. Rules continue to change throughout this. It was almost a running joke at a certain point in time, because it was like hourly. We had to kind of keep watch to make sure it didn't revert back to what we thought earlier. So we've encountered a number of situations where the wrong worksheet was pulled up and used for the reporting. It might have been done for round 1 or round 2, and you're on like round 4 of calculations, and you just grab the wrong one. So make sure whatever you're using is the right version, if you have multiple, to populate information. And then not retaining copies of documents, of support, and definitely of rationale. And just as important, making sure that those responsible, who maybe isn't you, or maybe it is, but there's somebody else is doing a piece for you, making sure they're holding on to stuff. The healthcare industry has a high level of transition among different roles, right? And I think we've all seen that. whether you're a controller, CFO, pick your accountant, pick your position, those have turned over quite a bit over the last few years. And so probably the number one issue that we have come across, or at least that I've come across, has to do with individuals that are no longer in their roles that were responsible for all of this, and that documentation was not retained anywhere, could not be found, or nobody else knew about it. So making sure that you understand where information is and that it is retained. There is a link at the bottom of this. You can see it there for the portal worksheets. That comes right from HRSA, the Health Resource and Administrative Services Group, HHS, HRSA. We kind of use all those interchangeably as essentially the government that submitted these funds and are overseeing them. So given that HRSA provided those worksheets, we do recommend using those at least as a component of tracking your information. Next common error. If you have multiple legal entities, making sure that you are accounting for each of them appropriately. This comes in a couple of different respects. First off, make sure that if you have subsidiaries or even separate legal entities, that each one that got funds are being tracked and are being reported on. You know, you aren't, if you have 10 different companies, you aren't reporting on 8 of them and accidentally missing 2. Or if you have a number of subsidiaries and maybe individuals at those groups are responsible for their reporting, they may think that you're doing it. So ensuring that everybody as part of that reporting entity is included in the report. And then it gets a little bit trickier, but you'll read here, and hopefully you'll have this information available. Depending on the type of distribution, it impacts who will report on it. So for general distributions, when you have multiple related parties, a parent can report on everything, or a subsidiary can report on their piece and a parent can report on only the amounts they received. So it can fluctuate and you can determine how you're going to report that. When it comes to the ARP rural payments, those have to be retained by the tax ID that received them. There were some situations where the funds, however, were distributed to a parent, and the parent was provided information as to which subsidiaries should have received the funds. And again, it has to be used by the entities that were expected to receive the funds. But then when it comes to the reporting, it is the tax ID number that received the funds should report on them. So if the parent got it, then the parent's required to report on everything, even though the subsidiaries were required to use it. So slightly confusing. Just make sure all the payments that you got, you know, are being accounted for somewhere else. Eligible expenses. So Ashley already alluded to this earlier. The absolute, by far and away, #1 question I guarantee both of us and many others get is X expense allowable? And the #1 answer that we give is potentially, right? So what is your situation? Does it qualify? Is it used to prevent, prepare for, respond to coronavirus? I would say there have been situations where that eligibility requirement is overlooked just because it potentially falls within the period of availability. So on that chart that Ashley showed earlier, for all these funds, the beginning date to be eligible is the beginning of the pandemic, no earlier than January 1st, 2020. That doesn't necessarily mean an expense incurred in January of 2020 is attributable to coronavirus, or an expense that was incurred in December of 2021. So just because it's in the right time frame doesn't mean it's attributable to COVID. You still have to make that connection, whatever it may be. And there should be some connection. Some things are fairly obvious, right? If you are buying additional PPE or personal protective equipment, since that means different things to many of us, seems pretty reasonable. And probably still want something there, but it's not a long shot. If you are doing a more generic expenditure, something very specific to you, or even something that is relatively common, let's say computer purchases, ensuring that you have something that shows how this is attributable to COVID is important, very important. I think this is the highest risk of not being able to retain funds, because as Ashley mentioned earlier, the burden of proof is on the provider, it's on the recipient. So it means you need to make sure you have the documentation, not just an invoice. The invoice shows you made a purchase, not that that purchase was attributable to COVID. So make sure you have that connection. The second piece on the bottom of this is there was a limitation to executive pay, executive compensation. So no amounts may be applied to this program in excess of those balances, and you can see them listed on the screen. Sometimes that is not always considered because you're breaking down salary levels or amounts claimed into various categories, right? It might be by hour for some people, by pay period for others, by month for others. And there is also a potential consideration when somebody maybe isn't an employee, but they're essentially getting a salary through that payment. If you read the definition that's right from the terms and conditions, it says through a grant or other extramural mechanism. What that means, I'm not sure we still know. I've tried to figure that one out, and luckily I think a little open to interpretation. However, if the only reason somebody isn't an employee is because they are a 1099 contractor, but that amount is essentially compensation, you may still be subject to this executive pay limitation. So don't brush past that. The eligible expenditures, as I talked about before, cost before or after the period of availability, that's even more clear. So if you have a cost that was from 2019, that likely does not count. And if you have a cost that goes past the deadline, so as we're talking here, phase 4 or period 4, that deadline was December 31st, 2022. If you didn't get it in and you're trying to get a cost done now, then it's not going to count because it didn't fall into that period of availability. Also, incurring the cost and the actual payment. So things like leases aren't fully allowable because that's a future payment. The government's already funded whatever you plan on buying with the cash, right? Because you got the cash in the door on day one. So not using leases as a whole, you can use leases, but maybe it's only the payments that are made on that lease would be qualifying expenditures. And at the bottom, you'll see some examples of costs that potentially may not be allowable or vice versa would be allowable. So again, if services are rendered, if items are received, those generally are. The caveat to that is construction projects, and there's a number of frequently asked questions on this, but one very specific. And it does say if a project, and it doesn't even say a construction project, it just says a bundle of goods and services or a bundle of services of tangible items. If they really can't be separated, like a construction project, that entire bundle needs to be complete by the end of the deadline. So make sure that you're not overlooking this component as well as you're identifying what you're planning on claiming. All right. Claiming items without supporting documentation. That one seems pretty clear, and I kind of already alluded to it earlier, but this is probably the number 2 issue, is having items on a spreadsheet, but just because they're on a spreadsheet, again, doesn't make them necessarily allowable. So ensuring that you have adequate documentation, and that not only includes, incurring that cost, but what is that tie to being attributable to COVID? Amounts that are not based on actuals. And again, we've ran into this because oftentimes groups, as they went through this process, you're monitoring things as you go. right? You got a set number of a set amount of dollars you received, and you're trying to spend it and use it. And so as you're tracking that to figure out, hey, how much do we have left to spend? You'll put down things that are maybe budgeted for. And unfortunately, maybe not go back and update that information on the back end when it actually happens. So make sure whatever's on your spreadsheet is actually based on the expenditure, not a budget, not an estimate, not a purchase order, because the actual could vary from that. Similarly, duplicate expenditures. So oftentimes it isn't as easy, and especially for the first few phases, I mean, none of us had a process in place to track expenses through the GL. I think many groups have changed that, and you might have a COVID expense GL category. But still, you probably have two separate tracking mechanisms. You might have those general ledger accounts, and then you probably have a more manual tracking where you're looking through purchases, or you're looking through capital asset acquisitions or schedules you receive from department managers. If you have those two separate sources of information, it increases the risk that you may have the same expenditure on each one. So you might have something that was tracked in the GL and also tracked by, say, your IT department head, and now it's on both spreadsheets and you've claimed it twice. So beware of items that, you know, if you have multiple sources of information from where the documents are coming from, pay attention to that. And what you'll see hopefully on each of these slides, I'm not going through them in detail, but there's references back to either the terms and conditions or the frequently asked questions document to outline what it is we're talking about here. So you can kind of get a sense of what are the rules that I'm really trying to make sure I'm covering. All right, we're going to flip from expenses over to lost revenues. So Ashley already covered the three categories of lost revenues. But at the end of the day, a key function of lost revenues is it needs to be based on patient care revenue. And that is a defined metric. Now, there are still some things that are questionable, gray areas. So as you are looking at what falls under your patient care revenue stream, consider other things. Just because on your financial statement, something is maybe booked in an other or a miscellaneous category, it still may be patient care revenue. And so you may need to include that. And that could increase or decrease the lost revenue. Similarly, there are times where items that are in your patient care line really don't meet the definition from HRSA as to patient care. And you'll see that definition in the fourth bullet point here. So an example, prescription sales revenue. And often I think of this as more of like a retail pharmacy. You know, that might be in your normal patient revenue line, your metric that you follow, but it's pretty clear that they intend to exclude that, anything other than 340B program revenue. So pay attention to what are in your revenue accounts, what are you including, what are you excluding, and then back to that key point, documentation, right? Just because you are including or excluding something doesn't mean someone can follow that same line of thought. So any changes that you're making, make sure they're down, they're documented, and they're understood. Along the lost revenue lines again, with each of the different reporting options, we've ran into issues. So we outline here, and I like this chart because it kind of does outline the various options and what needs to be done for each. But with the reporting option 1, that's really where you're comparing actual from post-pandemic to actual pre-pandemic by quarter. One of the most common issues we have is doing that calculation, but making modifications. You know, it's post-pandemic revenue, except for this happened, so I'm not going to include that. Well, as soon as you make a modification, you're into option 3. So being able to know which option you're selecting, very important. Option 2, and Ashley already stole the thunder on that, that budget needs to cover the entire period of availability. And in this case, for phase 4 and ARP rural, the end of the period of availability is December 31st, 2022. So not many groups did a budget for that entire period of time. Not very often covered throughout. Option 3, and I kind of alluded to this earlier, I think HRSA scared a lot of people away from option 3, but as we talk to different individuals and especially groups within that agency, I think there is an actual more of an expectation that this would be the more common method, because it does require you to specifically note why your losses are attributable to COVID. So for option 3, I think we're going to see, especially for this round, a lot more people using it. And that isn't a bad thing. It isn't a scary thing. And I honestly have not seen one audit or one rejected option 3 calculation yet. That doesn't mean it still might not happen, but haven't seen it. So for option 3, I think the key takeaways is if you have an explanation of how you're calculating lost revenue, you need to follow that calculation. You can't vary from it. Anything you're varying from, you need to make sure that you have in that explanation. And so oftentimes it's one of two things. The explanation is too simple. It doesn't include everything that you're doing to explain, hey, how do we calculate this? Or it explains something, but you do it differently. So make sure that your calculation and your explanation track together. Lost revenues as well. Patient care is net of contractual adjustments, bad debt, charity care, all of those revenue adjustments. So make sure you're including all those, including bad debts. So for some groups that are on this, bad debt is maybe an operating expense, not a net revenue item. And so you don't really consider it, but you need to based on the definition from HRSA. And finally, not considering items that potentially cross quarters or cross fiscal years, because for most of the measurements are on a quarterly basis, unless you use option 3 and explain a different time frame. So if you have a loss in quarter 1 and not in quarter 2, well, impacts that cross over those periods, that can make a big difference. So make sure that you're identifying those things that cross over, especially when they're not at your fiscal year end. And then audit adjustments, close adjustments, those types of things. To the extent you can, try to include the impacts of all of those. That's probably the third most common scenario that we see is adjustments that happened after the reports were pulled. So pull all your reports as you were supposed to. They actually tie back to support, but changes were made later and never recaptured within your calculations. Not using your standard basis of accounting, relatively straightforward. If you're cash basis, it should be based on cash basis, not tax or semi-accrual. If you're accrual basis, it shouldn't be based on cash. So making sure you use that standard basis of accounting, again, unless you explain something different, and then not reconciling back to your numbers. So pull a report and assume that number's right, even though maybe that report didn't grab everything that you thought that it did. Some other matters, reimbursement from other sources. This was a key piece. That's one of two areas when it comes to being attributable to COVID, right? It needs to be to prevent, prepare for, or respond to, and it can't be reimbursed by another source. So if you already got that amount covered by PPP, by a grant, if you are cost-based reimbursed, those all should be reduced when calculating out that expense. So in here, I just kind of point out the cost-based reimbursement factor. So critical access hospitals, pilot program facilities, anybody on a cost-based reimbursement. If that cost you're claiming flows through whatever mechanism that is, it needs to be accounted for. If the cost is covered in full, you can't claim anything. If there's a ceiling or a partial coverage, then the amount that is paid for by that other source should not also be claimed. And then finally, as we go through and we looked at many of these errors, when the first and second reporting portal reports were done and single audits happened, errors were identified. And part of the resolution for those errors was replacing right? So I had well more than enough lost revenue. So even though this expense didn't count, I'm still good because I have excess lost revenues. Well, you got to make sure you're not claiming those again when we get to this time frame. So if you did do any replacement, make sure you're not double dipping and claiming that specific item again. And what if you disagree with a repayment request? It's not a fun process. However, there is some mechanisms for requesting a decision review. I have not been through this process yet, so I have no idea what it looks like. It's actually fairly newly provided out on the website. But there is now a process. If you get through, let's say, a single audit, then a separate audit from HRSA, and they're saying, well, you're going to have to repay dollars because there's amounts we don't consider allowable, you can request this decision review and get someone else to weigh in on those thoughts. So many historical errors, issues, etc. Ashley, if you want to jump into reporting updates, this will kind of maybe help point out what to do now that we know all those things that happened.
Yes, absolutely. So just talk a bit here about the period for reporting. And so first off, again, talked about a lot of the old things out there, but really, what do we have in addition to just those reminders and findings that Tyler went through? What do we have in this reporting that is new? And so first off is the American Rescue Plan, or that ARP rural distribution reporting, has now been added. And so what are the ARP rural funds? So these would be the funds that you potentially received when you did your phase 4 application. If you checked the little box noting that you'd like to be considered for a rural payment, you may have received this. And so essentially, the ARP rural piece, the terms and conditions are going to be the same as far as what they can be used for. It's those expenses: prevent, prepare, respond for coronavirus, the healthcare related expenses, the lost revenue, all of that we've just covered. But really, the nuances here are just some with the reporting. And I know Tyler already covered this, so we won't go into a lot of detail, but just talking about how the recipient needs to retain that payment within the entity that actually qualified for that payment, and that essentially that parent is going to be the one that is essentially required to do that reporting. So just to keep that in mind, there can get to be some strange nuances with those reporting pieces. So just making sure that you're tracking that. But as far as the reporting itself, so for the ARP rural distributions, essentially the expenses for these are going to need to be reported separately from any other provider relief fund expenses. So in this case, it's highly likely that if you do have an ARP rural distribution payment that you are reporting on in period 4, you probably also have a general distribution payment that you are reporting on as well. So what's going to happen is when you actually go through the reporting, you are going to have 2 different expense boxes that pop up. And so the first one is going to be this reporting of your expenses for that ARP rural distribution payment. And so I just have a little snip here from the reporting guide. It doesn't have the full table, but just to give you an idea, it will show you, okay, what is your total ARP rural payment? And then that's essentially where you would report on the expenses for these. And then again, as you have the other payments, you're going to have a second box that we'll see here on the next slide to report on those as well. But just keep that in mind because it's a bit confusing, especially since the terms and conditions are very similar. And so the other key piece when we're talking expenses, and so here's the other screenshot of really beyond that ARP rural, you're going to have that other provider relief fund expense table just for the other payments as well. But the really key piece here with the expense reporting to keep in mind is that you only want to include expenses that are being allocated to the payments in the current reporting period. And so this is something that we see a lot of confusion surrounding, and I completely understand why, because when we look at the expense table here, you can see it starts back in that Q1 of 2020 and goes all the way through. So I think there's a tendency to want to go ahead, repeat, continue to put those expenses in, similar to what you would do on the revenue side. But just keep in mind, for the expense reporting, this is only the expenses that you are claiming against the payments that you received in this period. So do not duplicate. If you've previously reported the expenses, you may have zeros in those columns if you're not going back that far. So just really keep that piece in mind. You may be able to, if on previous reports you claimed things as unreimbursed expenses, in other words, they were not applied toward those previous payments, you may be able to include those as well here, but just make sure that you are not including any expenses that you have already claimed against payments, because that would essentially be doubling them up and claiming them twice, which you certainly don't want to do. And then on the lost revenue side, so big thing with the reporting now is that you can change your lost revenue methodology as needed. And so how this works, and we'll talk a bit about why this might be needed, and a little bit more about the method 3 reporting, as we think that might be a more common approach that we tend to see. But if you do decide to change your lost revenue methodology, when you select that you're changing the methodology, there's going to be a box that pops up that will make you explain the reason for the change in your calculation methodology. So that's key point number 1, is just keep in mind that if you do change, you'll have to explain why. And then also you'll need to go back and recalculate that lost revenue for the entire period of availability. And so if you're saying, okay, I'm going from a method 1 to a method 3, it is then going to make you go back and re-show it for that entire period. So just something to keep in mind. So when might you change your methodology? Because I know I'd be thinking, okay, why do I want to do anything different? Let's just keep this rolling, not do anything drastic here. But there are a number of reasons why, especially as you continue to move through the reporting, that it might make sense to do a change in methodology. And number 1 is related to what Tyler just spent some time talking about, is you have some previous reporting errors that you need to make corrections to. And so as HRSA has noted in their FAQs, maybe you previously reported some expenses and you reported some lost revenues, and you went through an audit and it was determined that you had $100,000 of expenses that were not allowable. And so your auditors probably concluded, okay, you have enough lost revenue to cover it, you're fine. Well, now you don't want to report that full amount of lost revenue because you need to take out $100,000 of it in that example. So just really keep in mind, I know this can get a bit confusing, so something certainly work with your auditors on this, ask those questions, but definitely there may be times that it makes sense to adjust that lost revenue in order to correct those previous reporting errors and make sure that you're not double dipping on anything. Another common one is if you used a method 2 comparison to budget. If you were lucky and that was able to work for you, you were able to have the budget that was approved prior to March 27, 2020 cover your whole period of availability previously. That maybe still doesn't work because we're getting out pretty far from that time period. So maybe you previously used a comparison to budget. Now you no longer have a budget to carry forward. So that's likely a case where it might make sense to switch to method 3. And then to say, okay, we used our comparison to budget up until this point, the budget was approved. Now we're still using a comparison to budget, but it's not approved, or perhaps it makes sense to change something there. So unfortunately, I think a lot of providers going to get stuck with that approved budget. That can be a tricky one. Or also the other item is that maybe you really had a very significant change in your operations. So what I've seen here is maybe you just did a comparison to actual on your lost revenue previously, and that made perfect sense. But maybe now you've had a significant change in your operations where perhaps your revenues declined for a different reason. You lost a provider, something else significant that is just drastically skewing that lost revenue. Or maybe on the opposite side, you've had another major change that throws it the other way. So might just be those types of things that they make sense to evaluate and look and say, okay, does it make sense to go back and just look at this a different way since we have drastically changed?
And Ashley, the one I would add on there that I think unfortunately many may miss is if you had unallowable expenses like through an audit and you had to use lost revenues to replace those funds, then the system has no way of knowing that you use lost revenues to replace expenses. So in that scenario, I think you're going to be forced to use option 3, and you'll do the calculation probably the same way you normally would. You would just have to show, here are the funds we use to replace expenses, because that's the only mechanism through the reporting in which you can do that. And otherwise, you are at a high risk of double dipping.
Yes, absolutely. That's where it gets tricky, certainly, is that there are not a lot of other mechanisms to go through that process, for sure. So we keep talking about this method 3. So again, just wanted to do an overall reminder, talk a bit about what this entails, since I think it will be applicable for a lot of providers. And so really, what do you need to include there? So as I briefly mentioned earlier, calculation of your lost revenues, and then also a narrative which addresses the following items. And I think this is really key. The description of the methodology used. So what is it that you're doing? How are you doing the calculation? You know, as Tyler said, make sure that what you're doing matches what you say you're doing, you know, just going through that process. You also need to include an explanation of why the methodology is reasonable. So why is this the best way to show your true lost revenue attributable to coronavirus? And then another one that I commonly see missed is that description establishing how the lost revenues were attributable to coronavirus as opposed to a loss by another source. And so I know sometimes that can be really difficult to define, but at least to address within that narrative of, okay, really we saw these declines. There was nothing else within our community, within operations that would specifically cause this large of a change outside of the pandemic. So just to make sure that you're addressing those key points. And it really is important, you know, because as Tyler alluded to, while we really haven't been seeing, at this point anyway, we really haven't been seeing methodologies rejected. It is certainly something that HRSA has said that, you know, there's potentially a higher likelihood of audit and that they can reject those. So when we're talking something that could have a significant impact on your organization, if you did have to revert back to method 1 or method 2, take the time, make sure that you are really explaining and really making your case within that narrative. All right, so I think we've covered, like I said, the findings. We've talked through some of the reporting. So really to finish things up, we have about 6 minutes left. Just want to go over some final, I guess, tips, thoughts, you know, recommendations as you continue to move forward here.
So before you flip the slides, there you go.
Too late.
Okay. I can cover the first one really quickly for you. Everything that we talked about, I mentioned with all those errors, don't do them. Right? That's the next slide.
I appreciate your oversimplification. Thank you. Yeah. I guess I have nothing else to say. Maybe we're just done.
Pretty common. Yes. So we're not going to go through every yes. fix to every one of those scenarios. So figure out which ones you're at the most risk for and don't do them.
Yes. Well, that is slide 1. Yes. So I think just exactly that, you know, think through what you've done in your previous reporting. I know we like to think, okay, I had to deal with that last year and it was terrible and I don't want to think about it ever again, but revisit, take a look at it. You know, if there are some of those things that you think, hey, I think that was applicable to me, take a look at that, make sure that you're not repeating those. As Tyler mentioned, going through and completing those reviews. So I know we talk about, if you go through audits, you hear a lot about internal controls and segregation of duties. And I know it can be tough when you're in a small organization, but I think this is certainly a time where it is just really a good practice to have someone else involved. Have a couple of different people looking at this, just between checking the formulas, calculations, accuracy, not only of the supporting documentation back to the invoices or other support, but making sure that you could have a perfect spreadsheet, but if that's not carried into the portal correctly, you're not reporting the correct thing. So just having a couple of different sets of eyes on this, just because there, of course, is a lot happening and a lot going on, and again, a lot of dollars involved there as well. Just a moment. A little snafu with the slides here. There we go.
There you go.
All right. And so as part of this process, I think, the key here, won't spend a lot of time on it, but just find a way to stay organized. If that's creating a checklist, if you have, especially the more entities and the more complicated your organization is, just making sure that everyone's being covered, all payments are being covered, and really, again, that you just have that support maintained as you need it. This one here, we say too much focus on. We will never tell you that the entire report is not important, because you want to make sure that you are doing everything correctly. That being said, what we will say is, keep in mind when you're looking at the report, there are a lot of pieces that can be very overwhelming. For those of you that have completed it in the past, you'll know there's a table on other assistants and all of these statistics that are needed and all of these things. Again, just keep in mind the important parts that are truly driving your payment. And so while, again, you want everything to be accurate, you want your stats to be as accurate as possible, your breakdown of revenue by payer, et cetera, really keep in mind what's important. And that's really truly those total expenses that you're claiming and the total or your lost revenue and those calculations. So just try to step back. Again, want it to all be accurate, but just try not to get buried in the details that might not be as significant.
Such a politically correct answer to that one.
I tried really hard there.
Many of you who have had conversations with me on that before, you probably have a very similar response.
Yeah.
Not that it doesn't matter.
Well, I don't think we can say it doesn't
expenses.
matter. I don't feel right saying that. So that is my politically correct response. Oh, yes. So again, going back, talking about those previous reports and things, don't take shortcuts. Make sure that you're identifying those adequate expenses, look back at those previous unreimbursed expenses and determine if you have more moving forward. I think the key here is that it makes sense, to really, there is a cost benefit to this, of course. Like you might say, well, what if I just have more than enough lost revenue? Do I need to look at these expenses as well? Potentially not, but I think the key here just being, make sure you're doing a good and thorough job capturing what you can, because you potentially could have some items that are unallowable as well. And a big key. So as you're going through, and I know it's really easy to get deep into the details, we've all done it. A good thing to do is step back and say, okay, how would I audit this? So if I were to have to explain this, or if HRSA comes and asks me about details on my spreadsheet, can I provide the supporting documentation for this? Can I really show how we came up with this number? Because if the answer is no, and if you're struggling with that, sometimes either maybe it's not the right expense to claim, or you need to have some more supporting documentation, that type of thing. And really just make sure that you're retaining all of your invoices, support, rationale, those types of things, should you need to provide them. And I think we are right on time.
Yeah, if you did the work, make sure you're getting credit for it, and don't lose it. And don't store it in a shed on the other side of town in a building that's infested with spiders.
No, don't do that.
Yeah, I think hopefully as we went along, we tried to answer any of the questions. I don't see any other ones out there, but we appreciate everybody's time and attention. And I know this is a painful type of process, but on the good side, a lot of dollars received that were definitely needed in the communities that they were received in. So We wish you the best of luck in your reporting. And as you move along and things pop up, definitely reach out and we'll see what we can do to help.